Well, inflation does remain the name of the game. And we did actually see one high profile, prolific tweeter, of course, that being Elon Musk of Tesla, tweeting about inflation last night. He tweeted, quote, "What are your thoughts about probable inflation rate over the next few years?" Kind of probably not a rhetorical question, probably trying to solicit some feedback. But, here at Yahoo Finance, we do like to try to answer those questions if we can, at least. And we do have an answer from at least the New York Fed via some fresh data released just about 4 minutes ago. Actually, this is the updated chart of median 3-year ahead expected inflation rates. And again, Americans, as according to those that they polled over at the New York Fed, are expecting annual inflation at a pace of 3.8% over the next 3 years. What's interesting is that despite the kind of commentary that we've been getting about inflation being a much more elevated concern as of the last few months, up until February, the later parts of 2021 had actually shown people maybe expecting less inflation than they were in the middle to late parts of the fall last year. But again, that ticking back up between January and February, according to the New York Fed. Again, 3.8% now, the expected inflation. We'll see if that leads to unanchored inflation expectations as we do head towards that Fed meeting on Wednesday. Of course, that is going to be the big focus of a lot of those watching the markets, including Michael Darda, MKM Partners chief economist and macro strategist, who is watching this space very closely. Michael, it's great to have you on the program. In the face of these rising prices, the expectation is for the Fed to raise interest rates by 25 basis points, which raises the question, what is that going to do to inflation? Is that really substantial enough in your view?
Absolutely. Thanks for having me on. The 25 basis points is a completely foregone conclusion. It is fully priced in, and a succession of rate hikes after that are fully priced in for the year. Despite all of that, we still have elevated inflation expectations. So you were talking about some of the survey numbers. They're certainly well below the current rates of inflation. So we're not seeing, 8% expected inflation for 3, 4, 5+ years. But if you look at the TIPS market, the bond market, the expectations have taken a jump higher. At a 5-year horizon, we're pushing 200 basis points above the average of the last cycle. At the 10-year horizon, it's somewhat less, about 100 basis points. Yet, markets expect the policy rate to peak below the peak of the last cycle, right? So it might sound like a lot to assume that 5 or 7 rate hikes are priced in this year, but it's all front loaded. The expectations are that'll be pretty close to it, and the Fed will not get the policy rate much above 2%, if that. And I think those are the expectations that we could see start to move here as the recovery goes forward and as we see updated Fed forecasts.
So, Michael, you raised the point that, no one's really debating what the Fed's actually going to do in this meeting, but it seems like there could be a lot of focus and noise perhaps from the Fed press conference from Jay Powell at 2:30 on Wednesday, in addition to, as you alluded to, the projection of where future rates could go according to the members of the Fed Policy Setting Committee. How important is it going to be in terms of reading those tea leaves? Because as we know, those forecasts are just that, forecasts, and we're in the middle of a very uncertain geopolitical climate as well.
No doubt about it. Yeah, I think the focus will be on the press conference. Everything else is going to be carefully scripted. And then certainly the update to the Fed's projections will be interesting. We'll have to see if there's any movement in the expected, terminal policy rate. But just generally, the Fed's probably going to have to bring down its expectation for real GDP growth this year, but to bring up its expectation for inflation. It had been pretty optimistic on both, looking for like 4% real GDP growth for this year, but inflation really falling quite significantly. We know with these supply side shocks, the tendency will be to keep inflation at elevated levels. It does tend to reduce real growth. So overall nominal GDP won't change much, but the composition changes in an unfavorable way. It puts the Fed sort of in a pickle because it doesn't really allow them to move forward in a less aggressive manner. In fact, the inflation expectations market is telling us that the Fed is falling behind the curve further, and that its credibility, at least in terms of achieving sustained 2% average inflation, is being chipped away.
Michael, I mean, I love to talk about nominal GDP, but I feel like we just need to take a big step back and recognize how significant this Fed meeting is going to be. If they do raise interest rates as is expected, that'd be the first time that they would do that in many years, and obviously since the pandemic began. I know that your pup behind you is asleep, but it seems like people who are watching the markets have never been more on edge during this time than they've been headed into Wednesday.
Yeah, there's no doubt about it. I mean, the upheaval of this cycle, the way that we went into it with the pandemic and the unemployment rate shooting from 50-year lows to levels that we have not seen in post-war history in just 2 months, and then a big V-shaped recovery that followed it with now 40-year highs in inflation. It's been quite the whirlwind. So, and also we've had quite a bit of market volatility coming into the year. It had been a long period of time since the S&P 500 had suffered a legitimate correction, and we've certainly had one year to date with the geopolitical turmoil. And so we've got a lot of moving parts, in the macro landscape here. And so it makes sense that there's a big focus on this meeting.
What are you going to be listening for in terms of the commentary for future policy moves? Because Jay Powell was very clear in his congressional testimony that 50 basis points would certainly be on the table for future meetings, which gives you a little bit of uncertainty about the cadence by which the Fed is going to tighten this year. Are you expect him to be as clear and forthcoming as he was in the hearing when he actually said just outright, look, I'm going to support 25 basis points in this next meeting, which you really don't hear Fed chairs tend to do?
Yeah, that is true. Unfortunately, though, with the Fed slipping, the credibility slipping and the Fed falling further behind the curve, here's one way to think about it. Since January, inflation expectations have risen about 75 basis points. So with the policy rate just sitting still, the inflation-adjusted policy rate has fallen by 75 basis points. So a 25 basis point hike on Wednesday only really partially undoes the passive easing that has taken place with rising inflation expectations. So I'll be looking for Fed Chair Powell to address inflation expectations. What is the Fed looking at? And how are they likely to address a potential threat to their credibility? I was not in the 50 basis point camp that was getting going earlier this year, not because I thought it would be incorrect for the Fed to do that. I actually think if you're behind the curve, you want to try to catch up, and better to do that early on when you're well below the neutral interest rate than to panic and try to go for a catch up later on where maybe you're not as far away, and that's where recession risk starts to heat up. But I don't think the Fed wants to initially set in motion expectations that they're going to go 50 at a time. Rather, they start gradually. And then, as Powell said previously, if they need to get more aggressive, they will. Well, let's hear about what would trigger more aggressive. So maybe he can shed some light on that for us.
Yeah, we'll certainly be watching in for that. I got to acknowledge, your dog is conked out. Is that normally 11 a.m.? Is that normally the time to take a nap?
Fed macro puts him right to sleep.
It does for a lot of us. Michael Darda, MKM Partners Chief Economist and Macro Strategist. Thanks again for stopping by. Have a great week.
Thank you.